Yesterday, Governing Council took the decision to raise the policy rate by 25 basis points to 0.5%.
A quarter of a percentage point increase in March of 2022. The first of 10 rate hikes that have since taken the Bank of Canada's key interest rate to 5%, the highest level in 22 years. Though painful for many Canadians, the BOC says that when it comes to taming inflation, its steep tightening cycle has worked.
We've come a long way from the peak of inflation in 2022. Monetary policy is working, and we need to continue to let it work.
From a high of over 8% in June of 2022, consumer inflation has since cooled quite significantly, coming in at 2.9% for the month of January. But after 2 years of high rates, economic concerns have since shifted from inflation to growth and the possibility of a recession. 2 years ago, Canada posted 6.7% GDP growth in the fourth quarter. On Friday, fourth quarter growth for 2023 came in at 1%. Still, as Capital Economics Stephen Brown tells us, for the BOC, this is good news.
It's certainly not a good result for the economy, but it is this soft landing that the Bank of Canada has been trying to achieve, really. There's not been a recession.
For CIBC's Avery Schenfeld, that warrants a decent grade for the Bank of Canada's report card.
They've done a reasonably good job. There's always a bit of art and science here, so they would certainly get no worse than a B+. Maybe if they'd started a little earlier, we'd be giving them an A. But also, we don't want to give an A grade until we see the final paper submitted. In other words, until we see that inflation has in fact come down.
Nivrita Ganguly, Global News.